Hello, everybody. Delighted to be back here again. Well, the title of our next panel is about the global economy and whether the global economy is headed towards a soft landing. I'm very privileged to be here because we're going to have a fascinating discussion. And just to give you a little bit of context, the IMF released their World Economic Outlook report last week. They see 3.2% global growth in 2024 and 2025, though some low-income developing countries have been subject to large downgrades. But the IMF described this type of growth as stable and underwhelming. I would say is pretty resilient, given a couple of years ago we were talking about inflation, global inflation levels of more than 8%. We're now sitting at global inflation levels trending back towards around 3% by the end of next year. Central banks have been fighting inflation, and yet the world economy has remained resilient. Or has it? That is what we're going to be exploring on our panel today. So let me introduce our panelists, starting with His Excellency Mohamed Al-Tuwajri, the Vice Chairman of the National Development Fund. A pleasure to have you with us. To his left, André Esteves, the Chairman and Senior Partner at BTG Pactual. To his left, we've got Jean Hines, Senior Managing Director and CEO of Wellington. To her left, we have Bernard Mensah, the President of International at Bank of America. And then to his left, we have C.S. Venkatakrishnan, the Group CEO of Barclays. So plenty to discuss here, and I gave a little setup about what the IMF are predicting in terms of global growth. I also didn't mention some of the challenges, and some of the challenges that have come up in the discussions this morning include those around conflict, geo-economic fragmentation, tariffs, protectionist policies, climate-related shocks, and even financial market volatility. So, Your Excellency, I'd like to start with you. How do you see the state of the global economy right now, and what sort of ramifications are you seeing on the kingdom's economy based on some of the signs that you're getting from abroad?
So thank you, Jumana. Thank you, everyone, for attending this. Thank you for the audience. We're talking about a soft landing, hard landing, and I'd like to go back to my aviation days, and I'd like to see gauges. So we will land somehow, somewhere, but there are so many gauges that tell us what's going on. The biggest radar is the geopolitics, and it's everything that's taking place globally, whether it's China, Taiwan, Russia, Ukraine, Middle East, Sudan, etc. And this is very important because it's related to pricing risk, and it's related to volatility, and it's related to FDI and everything else. And the second one is where the inflation is heading. I know there's been a lot of interest rates moves. It is heading toward the target rate. Here in the kingdom, it's there. It's already, the target is around 2%. But the inflation picture is still a little bit uncertain. I also look at demographics globally, and there is a shrinking population globally. It's visible in Europe, it's visible in China. But this is also going to determine how things are heading. Environment debate, and the environment is very important. Whether there will be a recession or not, there is a probability now, which is 20% roughly. So all the radars are telling us that this is unprecedented, it's very uncertain, it's very difficult. We will be watching closely how the Fed is dealing with this in the next few months. Here in the kingdom, we embarked in this very impressive transformation journey. We've built the institutions, we've built the infrastructure, we've built the engagement with investors to be able to basically navigate through this. So whatever the outcome of the global economy, I think we're hopefully well equipped to be able to navigate through this. One of the institutions we've built 6 years ago is the National Development Fund. It's basically private sector enablement and absorbing shocks.
Yeah.
Thank you.
Venkat, I'd like to turn to you now, actually, because I'm going to go back to these IMF numbers. It's strategic because they came out a week ago, so well-placed timing. The US is seen growing at around 2.2% next year. If you compare that to Europe, Germany this year basically not growing around 0%. At best, Eurozone economy is growing around 1% next year. It really feels like in the context of advanced economies right now, the US actually is a relative bright spot. Do you concur?
Absolutely. I think the US has shown over the entire period post-COVID, not just impressive growth, impressive inflation control, and impressive employment gains. So, if you come back, Your Excellency, to the hard landing, soft landing, I don't know exactly how it will be, but if you took it 2 years ago and you said that we'd bring inflation into control the way in which we have had positive growth, even though it's close to zero in Germany, maybe 1% in the UK, and higher than a couple of percent in the US. And so you've had inflation control, strong employment, and interest rates coming back down to into the softer, I mean, to the cutting part of the cycle. We would all have been very happy. And I think that's the thing which we should take comfort in, along with what has been a healthy stock market in that period, maybe with a few concentrated names doing well, but overall health.
Bernard, can I just ask you as well from an international standpoint? The Fed have just started the easing cycle, but other central banks around the world in advanced economies have also started with the easing cycle as well. Do you think that that is actually going to provide a growth push? Is it going to provide a stimulus to growth as you look ahead into next year?
Thanks, and good to have me here. Yes, the Europeans cut as well. I think the impetus in Japan is slightly less, we'll see, just given the new government coming through. I think all of these things are a good thing in themselves. I'm not sure if they're a real growth catalyst. I think the economy is resilient. In the US, we see 60, 70 million consumer customers in our accounts at B of A, and their balance sheets are still healthy compared to pre-COVID. So I think that the US consumer is there. I think China has very specific issues around just where its economy is, and we can talk about that later. India seems to have decent momentum still. So I think that the central banks are trying to manage for inflation. Some of them are still trying to shrink their balance sheets from the expansion of the balance sheets pre-COVID and trying to manage to that. I'm one of those that thinks that there should be more of a fiscal and other impetus alongside the central banks to drive growth.
Let me just ask you, since you brought up China, China recently announced a fiscal stimulus, and China's recovery has been slower than many people thought. Do you think China are going to be successful at stimulating demand ultimately?
They've generally done a very good job in the past, and it feels like they've bitten the bullet on sort of, let's say, supply side incentives and setting up various support structures for local government, for some of the banks, for parts of the real estate sector. I tend to have confidence in the ability to manage that. One of the things that the market is, the jury's out a little bit, and I think the reason the jury was out is the market was looking for consumer incentives as well, and policies that would help the consumer maybe lower its savings rate and drive a more consumption-led part of the recovery. And the big debate is, whether the export-led, investment-led part of the economy is something that will sustain it through the next period of time. So we'll see, but there's certainly focus on it at the moment.
Well, Jean, I know that you tend to take a more bottom-up approach because you're analyzing companies' margins, profitability. And if you look at the stock markets, many people say stock markets don't necessarily reflect the real economy, but stock markets have been going from strength to strength in the US, and specifically led by a basket of stocks, those Magnificent Seven. There's a lot of hype, obviously, around those specific names, the possibilities offered by AI. How do you see the potential? And also, when in the context of growth, is what's happening within the AI space a secular story, separate to macro?
Yeah, one of the most interesting things when you look at the stock market and the earnings and where it's coming from, even though the markets are very concentrated, and they are very concentrated relative to history, they've begun to broaden out, is that the earnings and cash flow margins of those match. So it's not a mismatch based on the current earnings and cash flow of those companies. They're doing remarkably good companies. I think the other part, and I'm going to focus on the US now, that's quite interesting, is that with interest rates up where they have been in the last couple of years, you have just very high borrowing for small and mid-cap companies. And the US is made up of small and mid-cap companies. Of course, we have some big companies, but the beauty of the US economy is all the small and mid-cap companies. So that has really dampened the growth of that part of the sector. And so I think what's most interesting now, and I just read a statistic in the last week or so that small and mid-cap companies' earnings are down 20% over this period. And so what will be really interesting is as interest rates have begun to come down, and if they continue to come down, will you begin to see higher growth in a broader part of the economy? and then you will see a broadening out of the markets.
What do you think which are the sectors specifically that are going to be driving that growth then?
Well, well, one of the things I'll answer that in two parts. One is that if you have lower interest rates, it should impact many types of sectors, both from a fundamental perspective and both from a fundamental perspective. If companies can borrow at lower rates, they're going to have higher investment, and that will lead to growth. That's across the economy. And then you have a subset of sectors, such as biotech, something close to my heart, that is also driven, their earnings are so far out that you discount them. When you discount them at really high rates, the valuations of those companies will be lower. And I'll tell you an interesting statistic. I followed biotech for 30 years. Interest rates never were a part of the valuation until very recently. The ultimate value is whether they have new medicines and whether they change the standard of care of medicine. But in this period of time, you have these high growth stocks that you have to discount. And then maybe finally what I will say, if you look at AI, the promise of AI, those very high, well-deserved multiples now and the cash flows related to that will only sustain if AI is used broadly in the economy. And so I think we're optimistic about AI and the potential, but I think in order to sustain that, it will have to broaden out. Almost every company, all of our organizations will really have to adopt AI at a rate that will justify all that.
Yeah.
And so that would give me confidence that sort of the next leg of very interesting AI will come from companies all over the world.
Yeah. Well, Andre, I was in Brazil last week, and it was good to be there. And one thing that I did notice is that the Brazilian economy has actually also been upgraded. It's doing quite well, but then equally, there's a fiscally loose policy over there. And I do wonder, when you look at the drivers of growth the last few years, and certainly over the COVID years, fiscal spending came up a lot. But it feels now that we're getting to a point where people are getting a bit nervous about the size of public spending. Only last week, France, as credit was put on negative outlook. People are getting more concerned about the size of US deficits. Do you think that fiscal spending and the size of government's deficits are going to become an issue next year?
Yes, it will be. That's my feeling. We discussed about that in Bloomberg last week in Brazil. I think it's the whole spectrum of discussion, right? We started this year thinking that Fed would cut rates in March, and 7 other Fed cuts in the yield curve priced. We arrived in March, there was no Fed cut. And gradually, in the following weeks, all the other cuts were moved out of the yield curve. By mid-year, we had a view that no more cuts, eventually cuts in 25. And then a few more weeks, and we were afraid of interest rates hike again. And then a few more weeks, we forgot this idea, and we were worried about growth. In a few more weeks, we were really worried about growth, expecting that we were very close to a recession, and we needed an emergency cut from the Fed in an intermeeting meeting, something like that. But then a few weeks, we calmed down and finally got the September 50 bips cut. And 1 week after that, many Fed speakers came and said, well, eventually we need to reduce pace, or eventually even stop a little bit to see. And too much uncertainty, in my view. And part of that caused by even central bankers. I think central bankers are over-guiding markets. And with that, we are missing a very important piece of information, which is the market price. Markets are being over-guided, and we are missing the intelligence of price. Because today, the asymmetry of information from central banks and the markets are very small. And I think we need to rethink our central banking and try to use more what market is telling us. And something that market is telling us is that deficit is getting to a size that is not acceptable. And what caused my attention, looking as an analyst from abroad, is the discussion about deficit in the US electoral campaign, or better saying, the lack of discussion about deficit in the US campaign. And even if you are the owner of the printer, there is a limit to print, right? And when you look the long-dated Fed treasuries, you see US TIPS, or the inflation-linked bonds, trading around 2% for more than 1 year. And if you read any monetary policy serious academic work, nobody thinks that this is the neutral rates in US. It's something around 50 bips, maybe 100, never 200.
Yeah.
So these should be, I think, information for us, evidence of information that deficit is entering the radar of the markets in price. And I think it will get more serious and more serious if we don't take action.
Venkat, I saw you were nodding your head over there. So let me just ask you whether you think clients are actually getting nervous about the size specifically of the US deficit in years to come.
So I agree with what Andres said, and I would tell you that we had our second quarter earnings on the 1st of August, the day after the Fed did not move and the day before the Bank of England moved. It's a wrong time to have earnings. But you know, and he's right, because of the information asymmetry that was there. I do think deficits are important. Now, the US has a reserve currency, and that gives them a lot of freedom. And they can go further than most countries can because the dollar is the reserve currency. At the same time, I think it's really important for countries to be able to fund themselves and grow. And the case is the deficit is an important thing, but how you're going to use your money is also important. Tomorrow, there's a budget in the United Kingdom, where we are based. There is going to be a need to fund long-term infrastructure growth. People who've been to London would agree with that. And it's going to be important for the UK government, whatever they decide to borrow, and the sterling is not a reserve currency, to make the case, which I think they will compellingly, that it is about growth. But that burden of proof is much higher than it used to be, and that's, I think, the important piece.
And there certainly was an incident a couple of years ago where the budget wasn't received that well by markets. Speaking about long-term infrastructure growth, Your Excellency, I would like to ask you, given the dynamics of the global economy and the fact that some signals of demand have disappointed to the downside, that's also had an impact on commodities, the price of oil, and you look at the vision, the Saudi 2030 vision, and it feels as though there has been somewhat of a reprioritization that's taken place over the course of the last year. I'm curious to hear how that impacts the work that NDF is doing on the ground in terms of your prioritization of projects right now.
So that's absolutely true. The NDF was created to make sure that the SME sector in particular is strong, enabled, funded, because we understand that from an FDI point of view, investors like to see a strong infrastructure and a strong SME. So this journey has been 7 years now. We've created 6 new funds. And the whole idea is not to think only about growth, but to think about impact. So the reprioritization you're talking about is linked to this. What is it that makes sense for the Kingdom of Saudi Arabia to navigate through everything that's taken place? How do we create more jobs and make sure that the economic growth we're looking at, non-oil, is sustainable? So yes, we're looking at this, we're modeling it, we do a lot of stress testing, part of the whole Vision 2030. We're complementing in many ways what the PIF is doing. So for example, if we're opening up all these giga projects, we need to think who's gonna operate them, who's gonna maintain them, who's gonna basically service them. So this is the NDF come in play to basically navigate through this.
Yeah. Bernard, I had a look at the Bank of America Global Fund Survey. It's always a good piece of research to get in your inbox every week. And this week, they were citing the 3 top tail risks as geopolitics, inflation, and US recession. It's interesting that tail risks, geopolitics is falling within the bucket of tail risks. But what is your sense for how geopolitical risks are being accounted for and factored in to your clients' decision-making at this point in time? When I talk about geopolitics, obviously in this part of the world, we talk about geopolitical tension, but then more broadly, you talk about geo-economic fragmentation, the possibility of even more tariffs worldwide. How much does that get factored into decision-making, do you think, right now?
I think it does. maybe, and Jean might have a sense of this on the asset side, but probably in two buckets. You've got the tail risk of things going really horribly wrong, where there are some big geopolitical events that are happening in the world, and outside of the localities where they're happening, the broader economies are not war economies. We're not repurposing broad economic activity towards military activity as is happening in the localities. It's the economies are running as they will. So there's the tail risk of if something goes horribly wrong and you're really having to do that, materially increasing your defense budget or really putting resources in that way, then of course business people need to think how that might impact things. And then there's the general sentiment around that and confidence levels and a worry that things may go horribly wrong. But in the broad range of sort of BAU, as it were, then I think the geopolitics manifests itself in trading relationships, tariffs, non-tariff barriers, and that can permeate into economic policy as well. So you've seen tariffs on cars and EVs, and the EU has debated at length what sort of tariffs they should put on Chinese EVs. And and that has been a rigorous debate, and some governments were for that and some were against. There's a lot of debate as to what the US's policies on tariffs might be going forward. And around the world, there are lots of micro constituencies in different parts of the farming sector and in other parts of the economy that are feeling that sort of the tensions of growth, or are feeling the effects of inflation. And insofar as governments are not able to come to a broad agreement around, a framework for deciding these, then I think businesses are a little bit worried. I mean, I'd say very broadly, the WTO hasn't worked very well recently. And you can argue for all the reasons why that isn't a mechanism to solve trade disputes. But that is a concern at the back of it. And then I think, finally, instinctively we all recognize that perhaps some of the economies might not be in so much of a balance. If you take debt to GDP levels, the US is just a little bit over 100, France is maybe 110, 120, I don't have the exact numbers, the UK is around about that, Germany is at 60.
Yeah.
It's not clear that Germany should be at 60, I'm not sure France should be at 120. China probably has too high a savings rate. And so our ability to adjust for that, whether it's Plaza Accords or whether it's WTO type, those mechanisms aren't working so well. And I think that's where some of the geopolitics comes in.
Fascinating. Jean, when I was talking about some of the risks for markets next year, for the global economy next year, I did mention financial market volatility. And I'm recently reminded of two strange events that happened in markets. I walked in one Monday and the Nikkei was down more than 10%, massive drops. And one thing that's happening with these markets is you're seeing hotspots, areas of concentration, which means money goes in quickly and money goes out quickly. To what extent do you think that is becoming a feature and also a concern for financial market participants?
Well, the markets, the structural change in the financial markets over the last 20 years has been profound, like really profound in the sense of it used to be that long-term investors priced the markets, and I think that's still true, like value still has to happen long-term, but in any short and probably multi-year period, sort of the systematic part of the market is pricing. And so I think you should expect, in my career as an investor over the last 30 plus years, we've had these moments and they seem to be happening at a greater frequency. And so for us as an asset manager, how do we adjust to that and how do we adapt to that? And so we just invest so much more in sort of risk metrics that help our investors determine where these might occur and how to address them in portfolio construction. Portfolio construction has to be so much more sophisticated than it was when I started out investing in the mid-90s. So I think it's a feature of the market. I don't think it means that we won't have well-functioning markets at all. I just think it's a feature of markets that it will be abrupt. And I think the one enduring part of investing that still probably is very, very differentiated is those that can take the longest term view.
Yeah.
That can really withstand that volatility. That's probably where you'll have the most differentiated returns.
Well, Andre, I'm going to round up the panel with you. And I guess you're going to get the US elections question because there is a big US election coming up next week. What do you think the return of President Trump would mean for the global economy, given his favorite word in the dictionary, as he told our editor-in-chief, is the word tariff?
Oh, maybe the best way of wrap up is commenting on the previous questions. And I will start with your geopolitical question about tensions. And I think definitively it's changing the landscape for global FDI. Absolutely. I'm not short-term pessimist with geopolitical developments. In reality, I'm a little bit contrary. I'm more constructive about what can happen in the next 12 months. I think we'll be better than the last 12 months in the world. But having said that, the tensions will continue to be there. And the tensions are enough to change the landscape of global FDI. So neutral, peaceful regions are getting much more FDI than the core of the divisive world. Because if you are a Chinese infrastructure company, it's not easy for you to make an investment in the US, in Europe, maybe in India, but probably you can do in Brazil or Latin America. So these kind of examples, I think, are spread over the world. So definitively, I see the tail risk, the existence of the tail risk changing the landscape of global FDI. Regarding US elections, I think markets are preparing for that, and I don't see a disruption in markets coming. Of course, we need to see the policies, the people, the appointees. Of course, a continuation regime is kind of a continuation. More or less, things will be similar to what they are. If we have a change in regime, we need to analyze people. But as was said here before, US, with all the challenge that it has, and we spoke about the deficit, has been an amazing economy and a huge attraction for global capital markets. So I'm not bearish with that.
Excellent. Well, Your Excellency and panelists, thank you so much. That concludes our discussion. Thank you.
Thank you.